video series. My name is Hyacinth Vassal. I'm the manager of the Intercity Capital Connections program here at ICIC. For those of you who are unfamiliar with our organization, ICIC was founded in 1994 by Harvard Business School professor Michael Porter. ICIC is a nonprofit research and strategy organization and the leading authority on U.S. inner-city economies. I encourage you to visit our website that has a host of tools to help small businesses and an interactive module for you to connect with other businesses and ask questions and join our discussions. Today's webinar will discuss how to get access to capital to fund your contracts and purchase order without using a traditional bank loan. To lead this discussion, we have Gerald Watson. He is the president of the Watson Group. Gerald is the author of the recently published workbook, The Secrets of Contract Financing Finally Revealed. Gerald has served as an intermediary and principal in contract financing for over 20 years. He has conducted numerous workshops and seminars throughout the country. I am pleased to introduce you to Gerald Watson. Gerald?
Thank you so much, Hyacinth. Good afternoon, everyone. Okay, we're going to jump right into it. We've got a little less than 45 minutes to talk, and we're going to open it up to questions and answers. We're going to start by talking about contract financing and what we mean by it. Next slide. So what is contract financing? First of all, it's the financing resources we need to enable us to perform on a contract. Very simply, the financing resources required to enable us to perform on a contract. What do we mean by resources? Resources could be raw materials, they could be supplies, they could be components, could be equipment, could be labor, or vehicles, all of the above. So what kind of contracts? Contracts basically fall into categories: service contracts, supply contracts, construction, and manufacturing. Next slide. So what's included when we say contract financing? But let's drill down a little bit deeper. What you're looking at is a list there. It's got about 15 different items on it. We got limited time, so we're not able to really get into all those. We're just going to touch on just a few. Purchase order financing, situations where you've just received a contract or purchase order to supply fencing for the Department of Transportation, but you're operating on a COD basis. You get no credit with suppliers. PO financing is designed to help to underwrite the cost of those materials. Or maybe it's mobilization funding, where you've just been awarded a contract with a Fortune 500 company. You got to mobilize 200 employees over 3 weeks. You got to cover their travel, their hotel, their per diem, their payrolls. And you got to do this up front before you invoice. Mobilization funding is designed to help us cover those startup costs. And we're going to talk a little bit more about mobilization funding later in this session. Progress payments financing. Maybe you're a construction contractor and you're paid on a percentage of completion basis, but you need money as you go to pay your subs, to pay suppliers. But you're not paid for 30 days, or even worse, maybe you're working on a pay-one-pay basis. Scheduled payroll funding. Major problem. And two of the biggest problems, in fact, many contractors face is, one is mobilization, and the second is covering payrolls. Whether you're a janitorial supplier or any type of professional service provider, you got payrolls that you got to cover on a weekly basis or a monthly basis or bi-weekly basis. Where factoring alone is not a solution, because you got to cover those up front. Scheduled payroll funding is designed to help cover those costs. Revolving trade credit. Maybe you're a wholesale supplier or dealer, where you're doing recurring purchases from the same suppliers to some of the same customers, but you're either on a COD basis or you're maxed out with your suppliers, or maybe you got no credit at all. Revolving trade credit financing is designed to establish a credit facility to enable you to purchase over and over again from those same suppliers and cover the cost of those goods. Equipment leasing. Maybe you got a contract just to provide service lottery equipment for a state agency, and you need vehicles, 45 vehicles with 45 employees. and you need capital up front to cover the cost of that equipment. Equipment financing can kick in and cover that. Or just an accounts receivable line of credit. Service contract, any type of contract, you're paid net 30, net 60, and you need funding to cover your payroll and operating costs as you go. All those examples, by the way, are actual situations from actual clients, real situations that have used contract financing in one form or another to help them meet their financing needs. Next slide. So who needs it? Three kinds of companies, fall into three general categories. One are companies that are growing too fast. They got contracts, they got purchase orders, have a line of credit with the bank, but they're growing faster than the bank can keep up with. Had a client not very long ago had been with their bank for 10 years, credit line $750,000 in the term loan as well, never missed a beat. But they started getting very large contracts, and the bank just could not extend them any further. Companies that are maxed out, got contracts, got purchase orders, have a relationship with the bank, but they're either upside down or maxed out on their existing credit. And as a result, they're unable to meet their existing payment obligations. But if they could get financing on their contracts, they could turn things around. You know, one of the things I talk about in the book is 5 different techniques or how to get financing if you're maxed out at your bank. Or you're unbankable, the third category. You just don't meet the bank's lending criteria. Maybe you got insufficient collateral, or the financial ratios are off, or not enough history. I mean, banks tend to look backwards and not forward. Or maybe it's credit scores. Or you're looking for a contract, and the contract is the only collateral you've got, and banks don't make loans based on the contract. So, next. So when we talk about contract financing, first of all, we're looking at what we call the contract life cycle. Every contract has a life cycle. What's a life cycle? The life cycle is the term of the contract. It could be 30 days, it could be 3 months, 6 months, it could be an annual contract or even a multi-year contract. But as you move through that contract, companies have financing requirements at different phases. Some need it up front. They need mobilization funding, money to get started. Some need it on the back end cash flow to speed up their cash flow while they're waiting to get paid. Some need it on a month-to-month basis as they work through that contract to pay their payroll and subs and suppliers. Some need all three. Contract financing deals with each phase of life cycle with regards to financing. So how is it different than bank financing? Next slide. Simply put, bank approval is based upon the creditworthiness of the borrower. The bank's looking at you. Contract financing is looking at your customer. They're basing their decision, their approval, the lender is, on the financial strength of your customer versus your company. As a result, contract financing can be used by companies that have limited assets, no collateral. In fact, even startups can be eligible to receive it. What about the term? Next slide. Banks essentially provide what's often referred to as interim financing. Interim financing could be, in many cases, a term loan, could be a short-term loan, could be a long-term loan, could be a line of credit. Contract financing funds transactions, typically short-term transactions. So it's transaction-based financing. Next slide. What about term? Bank loans, bank repayment terms are typically measured in months, hence annual percentage rate. Contract financing, on the other hand, repayment terms are typically measured in days, typically because they're tied to the invoice payment terms. So whether it's net 30, net 15, whatever the case may be. I started working with a client just today. They got a contract with the actual city of Chicago, service contract, annual contract, $500,000. Payment terms are net 60. Next slide. What about payback? Well, banks rely on payback from the borrower. They're looking to you to service your line if it's a line of credit, or if it's a term loan, they're looking for you to send in a payment every month to meet your monthly payment terms. Versus contract financing, where the lender is looking to your customer, the debtor, as it's referred, who sends the payments on your behalf directly to the lender, typically to a lockbox, and we'll talk a little bit more about that later too. Okay, in a nutshell, that's an overview. So how does it work? Well, here's the fundamental problem. The fundamental problem is that many small business owners simply can't create the collateral. If the contract is the asset, then the invoice is collateral. The problem is that most people, many companies, can't get there. They need money up front. And while factoring may be part of the solution, it's not the total answer. So they need money up front. What's the dilemma? Well, what it kind of boils down to is two things. Next slide. The lender's looking at two things. They're looking at performance risk, and they're also looking at something called a payment risk. So by making advances on a contract prior to performance means you haven't created the collateral, and even if you have and you've invoiced, how do they know they're going to get paid back? Hence, we have the payment risk. And we're looking at a company that could be a startup that may have limited or no other collateral, maybe poor credit or credit issues, and may even be a startup. So those are the issues. I'm sure some of you are, let's see the hands. For all those of you who know someone, know a company that's had a contract, walked into a bank and said, listen, I got a contract here for $150,000 or $500,000, or whatever the amount may be, and said to the banker, can you make me a loan? I'd like to get 50% or 40% or 70% up front. What happens? Well, it's typically a challenge because most banks don't make loans on contracts, but here's what it kind of boils down to. A contract is just a piece of paper. Value accrues through performance, and that's a key concept and a key fact. Value accrues through performance. It's something that we utilize. Let's take a closer look at that. So, next slide. So the foundation then for a solution is, see, if you can link payment to performance on the front end and control the cash flow on the back end, now there's the possibility of being able to structure some kind of financing situation that might work. Next slide. In doing so, you're what's called creating the conditions. Creating the conditions so that the lender can then create a variety of funding products, funding instruments. It's something that I refer to as a contract financing model. What does that mean? It's a process. It's a process where the lender extends financing on behalf of the borrower to perform on their contracts from creditworthy customers who've assigned and agreed to 4 payments on approved invoices directly to the lender. Once you have that in place, that then puts the lender in position to do a whole host of financing. And we listed some of those up front. When we get into questions and answers, I'd love to talk about this in more detail, but since we got limited time, we'll move on. So what's required? 3 things. First, verifiable performance. 2, with an assigned dollar value. And 3, where the debtor or your customer has agreed for invoice payments directly to the lender. For example, let's say someone's got a contract to provide, something real basic, janitorial services. So every day they're cleaning offices, dumping the trash. Well, it's pretty easy at the end of the day, at the end of the week, to determine if that office got cleaned or not, right? Pretty straightforward. Or maybe it's security services, or maybe it's a staffing company, and you got people who are working on site. The performance has got to be verified. Once you know that the services have been performed, there's an assigned dollar value that you're billing, either on a rate per day, rate per quantity, rate per value, and then the customer has agreed that it's happened. Now, when those things are in place, even though you have not invoiced yet, it puts the lender in position to be able to extend financing. So what are the costs? Here are some of the major cost factors. One cost is based on the funding amount, the size of the contract, the type of funding required. It's going to vary. The industry you're in, the number of funding transactions. Are they frequent? Are there a lot, or just a few? How complex is it? Maybe you've got a contract with a lot of subs and suppliers. Maybe you've got a type of contract, maybe it's a manufacturing contract. how complex is the funding transaction? And finally, how strong is your customer? And we're going to talk a little bit more about that in a second. Next slide. APR, so what does it cost? APR versus DFR. APR, annual funding, annual percentage rate, versus DFR, daily financing rate. You know, oftentimes, in one of the areas, there's a lot of confusion when it comes to contract financing. It's comparing the cost of bank lending to the actual cost of contract financing. It's like apples and oranges because they're so different. One of the reasons, again, is because bank lending terms are measured in months, hence APR versus contract financing, where the term is measured in days. Contract financing then is essentially a self-liquidating loan that's tied to the payment terms. That notwithstanding, here's a couple indicators. Next slide. And ultimately, you get into the basics of costs, and we don't have time to sufficiently get into that here in detail, but lenders, basically, you're looking at two scenarios. One where the rate is based on prime plus, based on the actual advance, prime plus based on the funds deployed with a monthly service charge. Could be prime rate plus 2, plus 3, based on the type of financing and based on the lender. Or it could be a flat rate based on the invoice face value, which is then prorated, as it's called, every 10 days or 15 days, 30 days, or even daily. Different types of lenders, which charge differently. Some will use one versus the other. Again, as we go into questions and answers, we can get into any of those in as much detail as you like. Next slide. Now, here's an alternative perspective on cost, and it also kind of gives you an idea as to why we're talking about apples and oranges. Contract financing is like renting money on a daily basis. How many of you have actually gone out of town on a business trip, rented a car? What are car rental rates today? $40 a day, $50 a day, 75, depends on where you're at, right? But let's say it's $50 a day. So you need a car for 3 days, so you pay $150. You put it on your credit card. You really don't think much about it, right? Let's just take a step back. Say $50 a day times 30 days. If you were to do that for 30 days, that comes out to how much? $1,500. $1,500 a month. Well, that's a lot to spend for a car note, right? For a car payment, right? You wouldn't pay $1,500 a month, would you? No, because you're only renting the car for 3 days. So here's the key. You're paying more per day on a daily basis for that money, for the use of that car, because you don't need it for a long period of time. You just need it for a few days. So you're willing to pay a higher rate per day for the shorter period of time. And that's what contract financing is like. It's like renting money on a daily basis. But here's one of the keys. Money is a material. Just like supplies, just like material, just like labor, it's a material and it has a cost. And one of the things that you have to do is include that cost into your bidding and pricing, one, to help ensure you meet your target gross margins, but also so you can convert it from a percentage to actual dollars and cents. But just like anything else, if you can't measure it, you can't manage it. So the key then is to be able to measure that cost, know what it is, and be able to convert from a percentage to an actual dollar amount, and then then you can look at the real costs and the real benefits. Next slide, please. Here's another alternative. How many know of companies that have had a contract, had a purchase order, and went out to seek an investor to invest in the business to enable them to perform in the contract? Probably one of the more expensive ways to go. Contract financing lenders, alternatively, don't take any equity in the business. They take equity in the transaction. They're in and out. Okay? End of the day, what you got to do is you got to look at the benefits. What are the bottom line costs and what are the bottom line benefits, and understand how to truly figure those out. Okay. The closing thought. Highest price you pay for money is the price you pay for the lack of it. What's the cost of missing a payroll? or how many have seen situations or been in situations where you had a contract or you could have acquired a contract or purchase order, but you had to forego it because you simply didn't have the financing to cover it, right? How much lost profit did you have, or how much additional profit did you have earned had you been able to perform? What's more expensive, okay? All right, next slide. So how do you qualify for contract financing? 4 major areas. We're just, again, going to touch on each one of these. Lenders are looking at 4 things. They're looking at the contract, looking at the terms and conditions in the contract. And with regard to the terms and conditions, they're looking at any number of things they're looking at the contract date, the contract term, delivery dates, acceptance procedures, scope of work, billing dates, deliverables. Is there bonding required? Is it not bonding? Are there subcontractors? How much are you self-performing? Default clauses, offset clauses, payment terms. They're looking at all those. Secondly, that they're looking at is the creditworthiness of the debtor. As I mentioned before, contract financing is primarily driven based on the financial strength of your customer versus the financial strength of your business. And they use a number of techniques for doing so. Yeah, it's interesting because, we usually see all kinds of situations. I've actually had several where the client, their credit was stronger than their customers. So how do you work that out? There's techniques and methods sometimes for doing so. Third, what is your business stand? Now, even though it's not based upon the financial strength of your business, lenders are looking at basically 2 things there. One, they're looking to see, to answer the question, are there any business issues or financial issues that could impact funding? And on the financial issue side, they're looking at 2 things. Are there any tax liens or judgments from lending institutions, from the IRS, associated with 941s or whatever the case may be, that could impact funding? If you have a tax lien or a judgment, does that mean you cannot get financing? No, it doesn't. In fact, there are ways and techniques to work that out. That's something we can, again, get into. Someone like to fill in that questions and answers. But they look at that. The fourth is the owners. Now, different lenders work differently. Different lenders have different approval criteria. Most base it on your credit score. Do they pull credit? Some do, some don't. Is credit an important factor? For the most part, with many contract financing lenders, it's not. So what's the purpose of pulling credit? Well, some look at patterns, even though, let's face it, after this economic tsunami that a lot of companies went through, even a lot of strong companies are been struggling to survive and trying to pull out of it now. But they look for patterns, payment patterns. And if they got some issues or concerns, then it'll be, it may be an issue if it's not explainable. But the fact is, I've worked with clients who've had very, very low credit scores, some well under 600, some even in the 500s, so we've been able to secure financing for. Next slide. So how do you qualify? One, here's another concept. Pre-qualify the lender. Make sure it's a good fit. Saves you a lot of time down the road. All too often, a company will seek financing, won't know much at all about the lender, what they do, what their criteria is. Is there a good fit with regard to them meeting your needs? And, over the years, you hear horror stories from clients and from other lenders, but here's the bottom line, folks. Just because you picked the wrong spouse doesn't mean getting married is a bad idea. And so take a step back, determine what kind of criteria, what's the best fit for you up front, and then use that as a basis for having a conversation with that lender even before you submit a formal package. It'll save you a lot of time. So where do you start? Well, the first thing you do is you look in the mirror, examine where you stand, and define what your needs are. And once you truly do that and have a clear picture as to what your needs are with regard to financing on that contract, on that purchase order, you stand a better chance of finding a good fit. I can't tell you, in fact, one of the questions I ask clients, potential clients all the time is, what was the game plan or the strategy for securing financing before you were referred to me? And some companies plan and they try and make arrangements up front. Others go out and secure a contract and try and secure financing, after the fact. Always be proactive. Develop a contract financing strategy up front so you know where you're going. You got a clear idea of what your options are, which will make your life a lot easier once you get going. Okay, mobilization funding. I want to come back to that because next to working with companies to help them to arrange funding for payrolls before they bill, this is probably the second biggest area that at least in my experience that I do work in, and it's an area that I actually specialize in. So what do we mean by that? It's designed, next slide. It's a financing facility designed to assist in covering specific line item startup costs included in the contract or negotiated and approved by the customer. Mobilization funding, startup capital. Next slide. Basically falls into two categories. One is where you've got a contract where you've got expenses that you've got to incur up front, which you can pass straight through an invoice or submit with your next invoice, or contracts where you have a large one-time expense item that cannot be charged directly. For example, a client which had a contract, they were actually referred by their bank, Wells Fargo. Fortune 500 company, did a contract with them and they had to deploy 200 employees to 9 different cities, and they had less than 3 weeks to do so. Okay, they had to cover their airfare, hotel, per diem, and payroll and car rentals up front. But the way their contract was structured, they could invoice for those expenses once they had come out of pocket and pay them. That's one type of situation. You can pass those right through. Other type of situation is number 2, where you can't. Going back to the company with the contract with the state lottery. Great contract, 5-year contract, $3.5 million a year. They had to hire 45 technicians that they were deploying around the state, but each one had to have a vehicle. So that's 45 vehicles they had to purchase. And they needed money for the down payment up front for that. Okay, now in that kind of a situation, that requires a different kind of solution. Okay, next slide. So when we look at mobilization funding, the first thing you do is understand where you fit. Well, what are some funding options? Well, they're all over the place. And these are just a few. Okay, and these are actual solutions that have been done over and over again in different situations. Let's talk about advance payments. One of the best sources of financing is your customer. It's also one of the least expensive. But the key is what you negotiate. You got to ask for it. Okay? Let's go back to the guy with the contract with the lottery. In addition to the lender providing financing for the vehicles and a working capital line to cover his monthly overhead, we started early in the process and looked at and identified key funding terms and conditions that for him to include and negotiate in his contract. And I indicated to him, I said, listen, what you want to do is negotiate an advance payment from your customer. And he did that, and they agreed to it. And so the way that worked out, on the day he signed his contract, his customer wire transferred $300,000 into his account. And here's how it worked. He got the $300,000 up front, and then it was amortized over the 5-year term. So what he did was whenever he submitted his monthly invoices, which are going to be around $320,000, $30,000 a month, they're just simply going to deduct $5,000 per month from that monthly invoice, and that's how that's going to be amortized. Interest-free financing. Advance payments work in some cases they don't, but you get what you negotiate, but that's one. A second is a mobilization invoice. Again, mobilization invoices are particularly good where you have one-time, non-recurring expenses. I had another client, they were a construction contractor. They needed money for the trailers. They needed money to cover bonding costs. They had a whole list of things they needed money up front for. Another client had a security contract. They had to deploy 17 people overseas. They needed money for weapons. They needed money for equipment, money for vehicles, et cetera, et cetera. I mean, I could go on and on. With a mobilization invoice, what you do is you negotiate, ideally, before you sign the contract, to be able to invoice for those items day one. Okay? Lenders, and then what the lender will do is once you have that invoice, they will finance it or enable you to get an advance against it or factor it where you're drawing about 70, 80, 90% of that invoice face value. Now, all lenders do that. Some will and some won't. From a perspective of some, there is a risk, because if you don't do the things that are detailed in that invoice, then your client's never gonna pay the invoice, right? So potential problem there, but I've seen it work over and over again. Again, just like anything else, you get these things worked out up front, it gets you well down the road. Stored materials. Stored materials is a major problem for a lot of, particularly again, construction contractors. Or maybe you're in IT and you have a contract to furnish and install computers or IT equipment. Or maybe you're a cable contractor and you got to go out and you got to acquire cable. First time I ran into that situation, it was my second client. I just started in the business a lot of years ago. And the guy had a contract, he's from Atlanta. He had a contract to furnish and install tile in a VA hospital. And he was on COD with his supplier. And so the way his contract was written, he could invoice once he had furnished the tile and then installed it. Well, what do we have there? We got a payment risk, right? And we got a performance risk. Because if we were to write a check for that tile, which we could have done, I was a direct lender, we wrote the checks, and yet it didn't get approved or didn't get installed properly, what's going to happen? He's not going to get paid, and we're on the hook for that supplier. So it required a creative solution to try and figure it out, and ultimately, after staring at the contract over and over again, here's the solution. Separate the furnish from the install. So if you can separate the furnish from the install, then the lender can step in, provide some type of a payment assurance or payment letter or whatever it can be negotiated with your vendor to cover the cost of those goods once they've been delivered and accepted by the customer. In his case, we're able to negotiate with the VA where he could invoice for the tile as stored materials, which we agreed to have put in a bonded warehouse. Once that tile hit that bonded warehouse, he could invoice for the tile. Okay, and we then negotiated net 30 payment terms with the supplier. We got a discount for prompt pay, paid the supplier early, used a discount to help offset his financing costs. He became one of the supplier's best customers. So stored materials, separate the furnish from the install. Mobilization facility, well, what does that mean? That could be, you see, the thing with mobilization funding is that it's not an off-the-shelf type of financing. Okay. In fact, if you ask a lot of lenders if they do mobilization funding, most will tell you no. So every situation requires almost a custom fit solution. I got a call today. Company in California, they've got contracts with major Fortune 500 companies and government agencies to put on conferences and seminars, and they get paid once the event has been completed. So what do they need? They need money up front. Money to cover the facility, money to cover printing, money to cover subs and vendors. That requires a certain type of facility. They're all different. The guy with the 200 employees who had to mobilize them to 9 different cities, that facility had to have one where we had to help with the travel agency, the airlines. It's got different components. So depending upon what you're doing is going to be depending upon how your mobilization facility is structured. Lump sum payments. Lump sum payment can be any number of things, but that's also gets to where we got the we're able to arrange the advance payment for the lottery contractor. And scheduled payroll funding. Major problem. You invoice once a month, but you got payroll every week. And how do you cover that? Scheduled payroll funding basically is a funding arrangement where the lender provides provides advances to cover those payrolls as you incur them based on your payroll schedule, your payroll cycle. We're going to talk a little bit more about that in a second. But it's designed to cover those costs up front. Third-party disbursement authorization. First time I ran across that, this client, it was an 8A firm, and just got his 8A. He had contracts to provide lumber and other commodities to the federal government, but his gross profit margins are only like about 5 to 6%. Very, very small. I mean, so small there's not even any real recovery and financing costs. In fact, and his payment terms were net 30. So what was the solution? The solution there had to be one where essentially I had to structure something where it was no cost financing. So what we did was got his supplier to supplier was a large company. It doesn't work in every situation, but they were a large company. They were less concerned about, they didn't need the money for the goods for their own cash flow purposes. They just wanted to know that when it was time for them to get paid, that it would get paid. And so we worked out an arrangement where the lender basically played what I call traffic cop with the money, so that when the agency did pay, it sent the money to the lender, and the lender in turn dispersed the money to the supplier. Supplier said, look, if we can get that in writing and work on an agreement, tri-party agreement, I'll agree to provide financing. We did so. It cost the client like a few $100. It wasn't a big deal. So just another technique. Okay, next slide. So what are some of the key factors for consideration? One, what's a lender going to look at when you look at mobilization funding? To be sure that have you done this before? They're going to look at your track record of performance. If you're going after a contract for $500,000 or $250,000 or $50,000 or $50 million, doesn't matter what the amount is, what's been your track record and experience in performing on contracts of that size? Now, does that mean that if you've never done a contract that size before that they won't fund it? It does not. But they look at that. They look at your performance, and they look at your background and experience either as a company or even prior to going into business, maybe working with another group. Two, utilize direct disbursements to vendors. So contract financing, what the lenders typically will do as much as possible is if you got vendors or suppliers or subs or travel agencies or car rentals or hotels or whomever it may be, they will want to make those disbursements directly to them to help to ensure that those things that are to be paid get paid. Same with payrolls. They want you to work through a payroll service, and they'll make disbursements directly to those payroll companies. Helps to make sure that not only do the people who should be on payroll are on payroll, but also ensures that your 941s and payroll taxes get covered and are paid as well. Three, maximize the use of financing instruments. So what do we mean by financing instruments? That's really a separate conversation in itself, but in a nutshell, a financing instrument is a piece of paper, okay, that your supplier, your vendor, your subcontractor, whomever it is, relies on from the lender that they will get paid. It's a representation. For example, let's assume that you got a supply contract, a contract to supply office furniture. You're on COD. And so what the lender may do is any number of things. One, they may provide that supplier with what's called a payment assurance letter. Payment assurance letter says that to guarantee a payment once that furniture has been delivered to your customer and accepted by your customer. Another form of financing instrument could be a disbursement, a third-party disbursement agreement. We just talked about that. Another could be a letter of credit. There's any number of different instruments, but it's a piece of paper. And why do you want to maximize the use of those? It's the cheapest cost of financing, okay? Because as soon as that lender writes a check, the meter starts running on the money, okay? So if you can use a financing instrument, typically they will have either rated a specific cost or even measured in dollars. 4, measurable performance. Again, if you can't measure it, you can't manage it. You got to know what it should cost. You got to have an assigned value so that the lender can then be able to structure the facility based on that. Documented approval process. Whether you need financing or not. It sometimes surprises me when I talk to a new client, a potential client, and ask them, well, what is the process for getting your invoices approved for payment? Again, whether you need financing or not, those are the things that you want to know exactly and specifically right up front. Lender's going to require it, especially if they're doing mobilization funding. Last but not least is minimize the cash conversion cycle. What does that mean? That's the time, from the time that you initiate the work to the time you get paid. Okay, because at the end of the day, getting paid is everything, right? So you want to minimize that time. And there are lots of techniques to do that. Okay, payment terms is one. Frequency of invoicing is another. And, we can get into that. In the book, I talk about that in detail. Okay, last point here, FAR 32. For any company, FAR stands for Federal Acquisition Regulations, which is governs the way in which the federal government contracts with companies, both small and large. The section in the FAR called Part 32, which is entitled Contract Financing. For those of you who may be involved in government contracting, they're the boilerplate, okay, that you see at the back of every contract, all those clauses. Those all come from the FAR. Well, Part 32, there's a whole series of clauses that relate to contract financing. See, the federal government can also be a source of financing if you have a federal government contract. You can request advance payments from the federal government on a government contract. There are provisions for small businesses. Okay, does that mean that just because you request them, you're going to be able to negotiate and secure them? Not always. But the first step is to know that they exist. And again, that's something we can talk about later in more detail. Okay, folks. That's all I've got. I'm not sure how are we doing on time. Tyson?
We're good. We've got some time. We've got some good time for some Q&A. So to be able to ask your questions, there's two options that you can use. You can either use your chat features and ask your question, or you can raise your hand. If you raise your hand, your computer or your phone we must be able to hear you. So we have some questions coming in, Gerald.
Okay, great.
And the first question is, for borrowers, what is the most important thing to look for when contracting or doing a purchase order financing?
I'm sorry, what was the question again?
The question is, for a borrower, what is the most important things to look for in the contract or purchase order financing? So I think he's trying to find what is the devil's in the details. What is it?
Well, I tell you, one of the things that you definitely look for, and again, this is whether you need financing or not, is gross profit margin. Okay, because that tells you how much room you've got. First of all, it tells you how much room you've got, not only to cover any kind of financing costs, even if it's bank financing, but how much room you've got to cover your overhead expenses, to get you to the bottom line. I've seen lots of contracts over the years where, like the one I mentioned with the third-party disbursement agreement, they're working on 6%. So where the gross profit margins are small, that means that the gross volume got to be fairly large in order for it to make sense, of course, because it should be a relationship between that and your overhead. So gross profit margin is definitely a key thing that you want to look for.
Okay, so Gerald, I'm going to just ask you to be. There's a little reverberation that we're picking up here. So one of the participants is asking for some clarity in the sound. We have another question for you, Gerald. What if there is a default by the customer? And the second question is, what if there is a dispute or performance-related issue that arises? Good question.
Okay, let's deal with the first part. What if there's a default? Default means your customer doesn't pay, and of course there are a variety of reasons why for a customer not to pay. If it's default simply because they just You perform, they don't have any issues with the invoice, they just have not paid. There's two types of financing. One is called recourse, and the other is called non-recourse. With non-recourse financing, if your customer does not pay, you have zero liability. Recourse financing, you do. Many forms of contract financing are in fact recourse financing. So you got one or the other. With regard to what happens at the end of the day, it's like any other type of financing. You go to a bank and you get a bank loan and for working capital for the business, and you have customers that don't pay. Banks aren't going to forgive the loan. They're still going to look to you for repayment. Lenders have no interest in seeing you out of business. Okay, and so what they'll typically do is work with you to structure some kind of a payment arrangement. If you have other clients or other contracts or other invoices, so they'll work out something with you to work things out. I had a client just not very long, recently, actually right now, and construction company, woman-owned company, first contract, had a lot of challenges. They were referred to me by one of the women's business development centers. I was able to get the startup funding they need to get the contract started, got them out the door, but then their customer essentially defaulted, and they were stuck. And so what we did there was we worked with the lender, and we just worked out another arrangement where they were able to secure some additional work. We continued to extend financing to keep them going. I work with their vendors to renegotiate payment terms, again on the same basis, because if the client went out of business, it doesn't serve anyone's purpose, and they weathered the storm, and they're in the process now of securing some fairly large contracts. So at the end of the day, if you got a default, one of the keys is communication, okay, and look at ways to come up with ways to work it out. Second part of the question?
The second part of the question is, what if there is a dispute or performance-related issue that arises?
Okay. That happens, and ultimately it really depends on the type of financing that you're doing, a lender is doing. If they're doing, let's say, receivable financing or factoring, that's a non-issue because those advances are based on approved invoices. If you're doing some form of contract financing, see, one of the keys, again, as I stated earlier, is value is accrued through performance. And so if you can document performance and the customer agrees to it and signs off on it, that then gives a lender to do an advance, again, even before you've invoiced. So that's an issue that can be addressed in that manner.
Next question, Gerald. What are the typical daily rates on a PO financing?
PO financing typically does not have a daily rate. Typically has a flat rate, and it depends on the type of financing instrument that's used. For example, with PO financing, the financing instruments can range from a payment assurance letter, which will have, and some lenders will charge a flat rate, some will charge a percentage. Some lenders will even provide payment assurance letters at no cost. You have some factoring companies, for example, who will provide a payment assurance letter at no cost based on the fact that once the goods have been shipped, they'll factor the invoice. There's also something called a standby payment assurance letter. Standby payment assurance letter is something that we created a lot of years ago because the idea is to enable the client to graduate with their suppliers, or they're not looking to the lender to back them up. And the way a standby payment assurance letter works is that you agree to make the payment to the customer, to your supplier rather, but if for some reason you can't, the lender steps in and makes that payment on your behalf. Okay, those tend to have a flat rate. In other instances, the supplier will want a letter of credit. Two types of letters of credit. One is a letter of credit issued by a commercial bank. The other is a letter of credit issued by the lender itself. The ones issued by commercial banks are, more expensive than the one that the lender issues on their own letterhead. The supplier may require a direct cash payment. That cost will be a function of whatever the rate is that you structure with the lender. A lot has to do with what is the size, what is the volume, what is the frequency. Typically, the larger the transaction, the smaller the cost. But just to answer your question, as a rule of thumb, okay, for PO financing, you're probably looking on the low side of 3 to 4%, on the high side of maybe 5 to 6 of the cost of the goods. Not based on the invoice face value, but the cost of the goods.
Okay, so next question, thank you, Gerald. Next question is, what if we have bonded jobs and current LOC from banks? Can we still get contract financing?
What a great question. What a great question. In the book, there's a section called How to Get Contracts, How to Get Financing for Your Bonded Contracts, because it's an issue. See, one of the issues of bonding is that, well, not the issue of bonding, one of the facts with bonding is that the bonding company requires, as the person asked the question knows, requires being in first position. Well, so does the lender. The lender wants to be in first position too. I've got clients that have bank lines, and the banks will not let them use those lines to fund bonded contracts for that reason. So it's an issue. I've got other lenders who love bonding contracts. I say, listen, if the company can meet the requirements of a bonding company, that's something we want to do business with. Okay. I've got lenders who will fund a job that's bonded because once there's a payment and performance bond in place, then they've got something to fall back on. So it kind of varies, but that said, it can be a dilemma. What it really requires is establishing a solution. Okay, if you've got a lender who has a challenge with that, is in working an agreement, and it's referred to as an intercreditor agreement between a lender and a bonding company, okay, where they both can be in first position. But they work on an arrangement where essentially says that, see what is a bonding company concerned with? Performance, payment and performance, right? So on the payment side, if you work it out where the lender is making the disbursements directly to suppliers, so now we know the suppliers are paid. Or they're making payroll directly through a payroll company. Now we know the employees are paid. Well, we've just solved those two risks, major risks, right? And so some bonding companies require something called funds control. Some lenders have funds control programs. Funds control is just that, making sure those things are covered. But to make a long story short, it does require, if you've got a bonding contract, you also need financing. Okay, it can be possible to sometimes structure something between the two. In some instances, there's a lot of variations on that. I mean, I've had one here just recently. The bonding company agreed to subordinate their position, take a second position, or allow the lender to take a first position only on that one contract that they were financing. So you can take a second position on a contract. You can take a first position on a single invoice. It just depends. Okay, but it can be possible.
Okay, thank you, Gerald. Next question is more, I think, trying to see if you work with this kind of firm. The question is, do you work with software companies? We have a Fortune 500 client and support projects lasting 12 to 36 months. We bill on a monthly basis. We have a large upfront customization / development cost that we do not bill separate from the monthly payments. Would you cover something like that?
Well, that's interesting, because there's The short answer is that could be possible. You know, that large upfront cost, it's kind of like acquiring a piece of equipment, right? Because that's really what it is. It's a resource. You know, you're a construction contractor, another contractor, or a manufacturer. In order to perform a job, you need to go purchase a piece of equipment that may cost a few $100,000, right? It's the same in your case. You have this large upfront development costs, which, you know, and again, based upon the way you're doing business now, you can't really bill for it. So you got to find a way to absorb it to fit into your monthly billing scheme. So you got to somehow find a way to do two things: one, cover it, and then second, amortize it. And that could be possible.
Okay.
Be more than glad to have an offline conversation about that in more detail.
Yeah. And in the interest of time, we're going to take our last question. If you have additional questions, you can either email them to me or you know, send Gerald directly, and we'll be happy to make sure your questions is answered. Gerald's contact information. Let me get to the slide here.
I think it's on that last slide.
Yes, his contact information is there, but feel free to either email myself or to email him or give him a call to have your questions answered. And Gerald, the last question is, can we offer the prime or customer a discount to finance a prepayment?
That's a very good question, and in fact, the answer is yes. Discounts and payment terms are methods and techniques for accomplishing a number of different things. And I mean, in the essence of time, there's a lot more that I can say that than we got time to cover on the phone. But it's one of the areas, again, that I address in the book, how to use trade discounts to offset your financing costs. I've actually got clients who use trade discounts or as a profit center, or they use financing or even factoring as a profit center. Because what does that enable you to do? You get an advance against an invoice. You use that. You negotiate payment terms with your suppliers. Now, to be sure, you can say, listen, Mr. Supplier or Mr. Customer, okay, you know, if you pay me in 10 days, I'm gonna discount X. But here's the key. Okay, here's what you got to do. You got to calculate the annual cost of that discount, because it has a cost, and there's a formula. Okay, so when you start giving away 2%, 3%, 5%, while you speed up the cash flow, what is it actually costing you? Okay, real important. On the flip side, when you're offering a discount for prompt pay, okay, you're reducing to your customers, you're reducing your costs. And that additional spread can help to offset your financing costs. I've got clients that have used factoring, okay, to improve their DMB rating because they're now able to pay their suppliers within a discount period, pick up larger discounts, and improve their credit scores as a result. Okay, so yes, it's possible, and it can definitely work.
So thank you, Gerald. Thank you very much for a very informative presentation. If anyone, if we missed some of your questions, please do send us email or contact Gerald. Gerald, we thoroughly appreciated your presentation. We'll be looking.
I'd like to.
Sorry.
Can I make one more comment? Do we have?
Sure. Go ahead.
You know, one thing I noticed from the list of attendees that there were several organizations there who provide support services, MNTA, both within the public and private sector. And one of the things that's really, you know, the whole area of contract financing is one that's really not understood very well. I work with a lot of banks, all kinds of organizations, and one of the things that you want to be able to do is